A great ETF combines low fees, broad diversification, and high liquidity. The expense ratio is critical because even small differences compound over decades. An ETF charging 0.03% versus 0.5% could mean tens of thousands of dollars more in your pocket over 30 years. You also want an ETF with high average daily trading volume, which means tight bid-ask spreads and easy buying and selling. Finally, look at the underlying index. The best ETFs track well-constructed, broadly diversified indices that give you exposure to hundreds or thousands of companies in a single share. For broad U.S. market exposure, a total stock market ETF remains the gold standard. It gives you exposure to over 3,500 companies from mega caps to small caps for a tiny expense ratio. For international diversification, consider a total international stock ETF covering developed and emerging markets. Bond investors should look at aggregate bond ETFs for stability. If you want growth tilts, technology sector ETFs and semiconductor ETFs have strong momentum heading into 2026. And for income seekers, dividend appreciation. ETFs focus on companies that consistently raise their dividends year after year. The simplest approach is a three-fund portfolio: a U.S. total market ETF, an international ETF, and a bond ETF. Adjust the ratio based on your age and risk tolerance. A common rule of thumb is to subtract your age from 110 to get your stock allocation percentage. So a 30-year-old might hold 80% stocks and 20% bonds. Rebalance once or twice a year to maintain your target allocation. Dollar cost average by investing a fixed amount regularly regardless of market conditions. And remember, the best ETF strategy is the one you can stick with through market ups and downs, and has low fees, broad diversification, and high liquidity. The expense ratio is critical because even small differences compound over decades. An ETF charging 0.03% versus 0.5% could mean